Tether now holds more US Treasury bills than Germany does. That's not a typo. A company most people have never heard of, that issues digital dollars you can't spend at Walmart, owns more American government debt than one of the largest economies on Earth. Circle filed to go public last year, but they didn't file as a technology company. They filed as a regulated financial institution. PayPal launched a stablecoin in 2024, not for traders, for payments. JP Morgan ran tests with the Federal Reserve on something called tokenized deposits. I started pulling these filings 6 months ago because something felt off, not dramatic, just misaligned. Banks were moving in a direction that didn't match what they were saying publicly. What I found isn't a conspiracy, it's a repositioning. Stablecoins aren't competing with Bitcoin. They're replacing the infrastructure your checking account runs on. And the banks building them aren't doing it to help you. They're doing it because they've already run the math on what happens if they don't. This matters if you keep cash in a bank, not because your money is going to disappear tomorrow, but because the relationship between you and that cash is changing, quietly, in ways most people won't notice until it's already done. I'm not here to tell you to panic. I'm here to show you what's already happening in regulatory filings, central bank pilots, and balance sheets that nobody reads. If that sounds useful, stay. Hit subscribe, and if this helps, give it a like. But this is the kind of thing that makes sense 6 months too late. First, we need to get clear on what a stablecoin actually is, because the name is misleading. A stablecoin is a digital token that's supposed to be worth exactly $1, always. You give a company $1, they give you one digital token. You want your dollar back, you give them the token, they give you $1. Simple. Except for the part where you have to trust that the company actually has the dollars. And here's where it gets interesting. Tether, the largest stablecoin issuer, holds $86 billion in US. Treasury bills, that's more than Germany, more than South Korea, more than most countries. Circle, the second largest, holds about $30 billion in reserves. Also, mostly treasuries. So, when people talk about stablecoins like they're some crypto experiment, they're missing the point. These aren't volatile assets. They're effectively short-term treasury funds that live on a blockchain. And that changes everything, because if you're a government, you suddenly have billions of dollars in demand for your debt that didn't exist before. And if you're a bank, you suddenly have competition for deposits that looks nothing like a traditional competitor. When someone moves $10,000 into USDC, Circle's stablecoin, that money doesn't sit in a checking account at Bank of America anymore. It sits in treasury bills held by Circle. The person still has dollars, but the bank lost the deposit, and banks noticed. November 2024, Circle files to go public. They don't file as a tech company, they file as a financial services company regulated by the New York Department of Financial Services. That's the same framework trust companies use. December 2024. JP Morgan launches a pilot with the New York Fed testing tokenized deposits. That's bank speak for stablecoins that live inside the traditional banking system. January 2025. Senator Cynthia Lummis introduces the Genius Act. One provision. Stablecoins can be used to pay federal taxes. Read that again. The U.S. government is considering letting you pay taxes with a privately issued digital dollar. February 2025. The Office of the Comptroller of the Currency updates its guidance on bank-issued digital assets. Translation: banks can now issue stablecoins directly. March 2025. PayPal launches PayPal USD. It's a stablecoin, but it's issued through Paxos, which is regulated as a trust company in New York. This isn't chaos. This is coordination. And it's happening fast, because everyone involved sees the same thing. Stablecoins are becoming the new infrastructure for moving dollars. Not Bitcoin, not Ethereum, not crypto gambling, just dollars, but faster, cheaper, and outside the traditional banking rails. Banks make money in two ways. 1, they lend out your deposits and keep the interest spread. 2, they charge fees for moving money around. Stablecoins threaten both. When you keep $10,000 in a checking account, the bank lends most of that money out. They pay you 0.5% interest, if you're lucky, and they lend it at 6%. They pocket the difference. But when you move that $10,000 into a stablecoin, it doesn't get lent out. It sits in treasury bills. Circle or Tether earns the interest on those treasuries, not your bank. And when you send money using a stablecoin, You're not using the bank's payment rails. You're using a blockchain. No wire fees, no ACH delays, no intermediaries taking a cut. That's why banks are paying attention. In 2024, stablecoin transaction volume hit $15 trillion. That's total volume. All not unique dollars, meaning the same dollar can move multiple times, but it's still massive. For context, Visa processes about $12 trillion per year. Stablecoins aren't replacing cash yet, but they're replacing the infrastructure banks use to move cash. And once that infrastructure shifts, the banks lose their position. So what are they doing about it? They're building their own. JP Morgan's pilot with the New York Fed isn't an experiment. It's a proof of concept. They're testing whether a major bank can issue its own tokenized deposits, essentially stablecoins, that stay inside the regulated banking system but move on blockchain rails. If that works, you could have a JPM coin that's backed one-to-one by deposits at JP Morgan, insured by the FDIC, moves instantly, 24/7, settles on-chain. That's not a cryptocurrency. That's a bank account that works like Venmo, but is actually backed by a real bank. And if JP Morgan does it, every other major bank will follow. Which brings us to the real question. What happens to your regular checking account? Because if banks start issuing their own stablecoins, they don't need your deposits to sit in a checking account anymore. They just need you to hold their tokenized version. And that version pays them the same spread, costs them less to maintain, moves faster, works globally. From the bank's perspective, it's better in every way. From your perspective, it depends. If you keep cash in a bank account right now, nothing changes immediately. But over the next 3 to 5 years, you're going to see a slow shift. First, banks will start offering digital dollar accounts. They'll market them as faster, more convenient, globally accessible. They won't call them stablecoins. They'll call them something safe-sounding. Second, traditional checking accounts will start to feel outdated, not because they stop working, but because the new version will be objectively better for moving money. Third, and this is the part most people won't see coming, the interest you earn on cash will split into 2 tiers. If your money is in a stablecoin or tokenized deposit, you'll earn close to the treasury rate, maybe 4 to 5% right now. If your money is in a traditional checking account, you'll earn whatever the bank feels like paying, probably close to 0. Why? Because in the new system, your stablecoin balance isn't a deposit the bank can lend out. It's a liability they have to back with treasuries, so they pass the interest through to you. But your checking account, that's still lendable, so they'll keep the spread. The gap between those 2 rates is going to create pressure, and most people will move their money to wherever it earns more, which means, over time, the traditional checking account becomes something only people who don't pay attention still use. That's not a crisis, it's just a shift. But it's a shift that repositions your relationship with your bank. Because once your cash is actually a token backed by treasuries held by a private company, even if that company is JP Morgan, you're not in a traditional deposit relationship anymore. You're in a trust relationship. And trust relationships have different rules. I'm not going to tell you to move all your money into stablecoins tomorrow. That would be stupid. But I am going to tell you to pay attention to what your bank offers over the next 2 years. If they launch a digital dollar account or a tokenized deposit product, read the terms. Understand whether it's FDIC insured. Understand where the reserves are held. Understand what happens if the issuer fails. Because not all stablecoins are created equal. Tether has $86 billion in reserves, but Tether has also never been audited. They release attestations, which are not the same thing. Circle has real audits. They're regulated in multiple jurisdictions. They're going public, which means they have to disclose everything. If JP Morgan issues a tokenized deposit, it's backed by JP Morgan's balance sheet and FDIC insurance. Those are 3 very different risk profiles. The point isn't to avoid this shift. The point is to understand it while it's happening, not after. Because the people who figure this out early get to choose their position. The people who ignore it get positioned by default. And defaults rarely work in your favor. So here's where we are. Stablecoins are no longer a crypto curiosity. They're a $180 billion market that's growing faster than most people realize. Banks aren't ignoring them anymore. They're integrating them, or building their own. Governments aren't banning them. They're regulating them, and in some cases, endorsing them. And the infrastructure your cash sits on is quietly being rebuilt. Not all at once, but steadily. This isn't about Bitcoin going to $1 million. This isn't about getting rich quick. This is about understanding that the boring, invisible systems you take for granted, how you get paid, how you pay bills, where your cash sits when you're not using it, are changing. And the people who see it coming get to make decisions. The people who don't get to react. I'll keep tracking this. I'll keep reading the filings. I'll keep documenting what's changing and when. If that's useful, subscribe. If this helped, hit like. Otherwise, I'll see you in the next one.